HOEPA triggers. The Home Ownership and Equity Protection Act, or HOEPA, as part of TILA Section 32, requires owner-occupied high-cost loans to provide borrowers with special disclosures and puts limits on special loan features. A HOEPA, or high-cost loan, happens when one or more of the three triggers are met. The current triggers are as follows. The adjusted points and fees dollar trigger for high-cost mortgages are listed on the screen. The trigger happens when the points and fees exceed the listed percentage for loan amounts over the amount specified, which is the adjusted total loan amount threshold for high-cost mortgages. The rate trigger is based on the loan's APR that exceeds the average prime offer rate, or APOR, by 6.5% for first mortgages and 8.5% for subordinate liens. For variable rate loans, the APR is based on the fully indexed rate. High Cost Trigger Test 1. Multiply the loan amount by the HOEPA points and fees trigger depending on whether it's a first or second lien. If the fees meet or exceed this amount, the loan is identified as a HOEPA loan. Let's do an example. The loan amount is $300,000 on a first lien loan. The points and fees on the loan are $6,000. Take $300,000 times by the current rate is equal to the number shown. Since the points and fees of $6,000 are below the trigger percentage of the loan amount, this is not a high-cost home loan. High-cost trigger test 2. Take the APOR provided and add the HOEPA APR trigger for a first lien or a subordinate lien. If the APR on the loan is higher than the APOR plus the HOEPA trigger, it is a high-cost home loan. Let's do an example. The rate on a loan is 6.5%. The loan amount is $373,000 and the APR is 10.5%. Let's say for this example, the current APOR is 3.87% and assume this loan is in a first lien position. So let's take the current APOR, 3.87%, plus the percentage trigger on the first lien loan, 6.5%, which is equal to 10.37%. This loan would be a high-cost home loan because the APR of 10.5% is more than the APOR plus the current trigger percentage of 10.37%. High-cost trigger test 3. The prepayment penalty trigger. If the lender requires a prepayment penalty that exceeds more than 2% of the loan amount, or if the lender can charge a prepayment penalty for longer than 36 months after consummation, it is considered a high-cost home loan. Let's do an example. A borrower receives a home loan of $400,000. The prepayment penalty imposed by the lender is $4,000. Would this be a high-cost home loan? First, we take $4,000, the prepayment penalty, and divide it by $400,000, the loan amount, which is equal to 1%. Since the prepayment penalty is only 1% of the loan amount, this would not be considered a high-cost home loan.